and some people don't even know some people don't even know how inflation affects us, rather. So, I mean, we thought it would be great to add other people and, share the knowledge, because that's what we are all about at Sinothile Stokvel. I am currently the chairperson of Sinothile Stokvel. And yeah, guys, I hope you guys enjoy the session. We also had, the opportunity to include Lesegisha, who is phenomenal within the finance space. So he's the one who's actually going to be speaking to us today. Before I hand over to him, I just wanted to read his bio, just so that you guys understand who he is, what he does, and where he comes from. Okay, please give me a moment. Okay, so I'm going to read his bio. Lesegisha, maybe you can switch on your camera so people can see you and greet just like a young hi, if that's okay. There's that smile. All right. Yeah. So, okay. Lesegisha is a venture capitalist with a deep history in auditing and the public sector, and advising numerous entities outside of it. Sorry, guys, I'm a bit nervous. He has dealt with varying cross-border transactions, such as businesses based in Lesegisha was selected as one of the co-authors of Africa 80 project, an initiative that gives young Africans an opportunity to provide solutions that will shape Africa's growth path in various fields. To this end, Lesegisha wrote Chapter 10 on investment, finance, and aid. Lesegisha is a co-founder to Thousand Capital Pty Ltd, an investment club that seeks to mobilize 1,000 young professionals to invest in establishing the township as a market ripe for investment. In addition, he serves on the board of trustees for Devon Park Body Corporate and the advisory board for Athilma Tech Pty Ltd. He has more than 7 years JSE investing experience and is prominent of the value investing philosophy. Lesegisha holds a Bachelor of Commerce Accounting Science degree obtained from the University of Pretoria, a Bachelor of Commerce Honors degree in Accounting Science, and a Certificate in Theory of Accounting, CTA, from Monash University. Please help me welcome Lesegisha Mthiyane. Yay. Just an FYI, guys, please, if you have any questions, you can put them on the chat and we will read them out. Please feel free to just keep popping the questions in there and I will just keep an eye on them, just so that we keep the conversation going. I do know that Lesegisha would like for this to be more of a conversation rather than a presentation. So yeah, over to you, Lesegisha. Thank you.
Thank you very much, Dumelo and Bali, for organizing this. Sinothile Stokvel, I'm hugely honored to have this platform to engage with you guys, as well as the audience. I think it's very generous of you guys to extend the invite widely. Wow, that bio. It's amazing how much you can do over a space of time, but also it's humbling actually to listen to it. For some feedback, I think I did the bio probably 3 or so years ago, where they said I've got 7 years investing experience. I was like, but that's
so it's a bit more.
Yeah, it's slightly more. Yeah. But Look, guys, I'm very honored to be here. I don't take these things lightly at all. The companies that you've seen on the banner or that you see on the slides, T1C, we invest in township businesses, and then Finance Hut, we do everything, finance, consulting, bookkeeping, taxation, you name it. And the what do you call it? The slogan there is "Here's control." And the idea has always been to give control to the users of these instruments. The financial industry is an industry that is very, very, very adept at making sure that you are confused, that you don't know what you're doing, so that we can help you. And I say we because I'm in the finance industry. So for as long as I have food to eat, it must be coming from somewhere. And I suppose it's from the confusion that we've caused in the industry. That being the case, these classes, I'm hoping can be dialogues that we can have around finance. And the idea is to actually, and you'll see, you're gonna receive the slides, and what's on the slides versus what I'm presenting is a lot more dialogues. It's a lot more type of a conversation. And the reason behind that, twofold. Number one, most of you guys are postgrads, and to sit in another class on a Saturday, I don't think is gonna be a lot of value. And as well, I've seen some of our marks as we're climbing the ranks. I don't want you to get 50% of my class and then say, hey, at least I've made it to the exam. I would like that you get every thing that we're going to be discussing. So the notes are there for the academic nerds, the people that want to sit down and go through the documentation and see what is the definition of an asset, what is the definition of inflation, those sort of things. We haven't cut you short on that. And what's also interesting, for those of us that are a lot more futuristic and forward-looking, I compiled the notes with the help of Mbali, but also with the help of ChatGPT. And what you're going to see and how they flow is the conversation I was having with ChatGPT. So the way the notes flow is exactly the way I sat down and I thought to myself, okay, I'm going to be presenting on these factors. What questions come to mind? What are the things that bother me? What are the things that I want to find out? Okay, after I find out about inflation, then what? How do I protect myself against inflation? That will be inside the notes. Under assets, liabilities, I think we'll touch on it in the conversation. But even there, I ask questions like, why is a house sometimes called a liability? So it's those sort of things. If I do get stuck along the way, or if you see me, got my attention is going, I've got the chats popping up on my side. So occasionally my eye just gets thrown there. And then, yeah, I get distracted a bit. So inflation.
I'll also keep an eye for you.
All right. Okay. Thanks a lot for that, Dumelo. I have a post-it note. I was actually going to post it there, so when they pop up, I don't even see them, but that's fine. Inflation, assets, investments, and liabilities, right? What is inflation? And as I said earlier, these are going to be the 5 concepts that you need to be financially independent. Today, we are doing 3. So inflation is 1. Assets, liabilities, and investments is 2. Those three go together, but it's 2 concepts that we're covering today. And then in future webinars, we're going to be covering interests, dividends, and expenses. We're also going to be covering compounding, and then we're going to be covering indexing, and then there'll be a bonus 3 or 4 nyana items that we'll be talking about, equity, capital, what have you. But the idea is that when we're done with this series, you should be more than comfortable to go to the JSE and just breathe in that 19 trillion worth of instruments that are flowing through South Africa, through the global economy, that sort of thing. There should be no intimidation whatsoever left over. So for today, inflation. And I just want to give you a bit of history that you're not going to find in the slides, and that's the value add of this conversation. There's the definition. On the history of inflation, so three very important dates that you're going to encounter in finance. It's the 1929 depression. I think if you've tried to pick up a book on in reading or investing, that's a date that often comes up a lot. That's the day where the stock market crashed more than it ever has in history up to that point. It since has crashed more, but 1929 is sort of the time that we called a wake-up call, and we came up with a lot of what you see in finance today as comes to how to manage stock markets and those sort of things. The next date, and this is where inflation starts for us, is 1970, that period between 1970 and 1973. And what occurred around that time, it used to be that when you work, you were paid in gold coins or maybe even silver coins. And currency, what we know as money, used to be gold. And that's why if you look at the, is it Scruffy McDuck, those Looney Tunes cartoons, whenever that guy says, I'm rich, he's throwing up gold coins. And that's because money used to be linked directly to the amount of gold that is sitting in a vault in the bank somewhere. And there was almost perfect parity. So we used to be able to track this that you have done is worth so much in gold. And that's essentially how the economy was right up until that era, 73. And that's what most of us till today, we still refer to as the real economy. What happened around that time is that I think it's President Nixon or Ronald Reagan, but I think it's Nixon. Reagan is more in the 80s. President of the United States decided to remove the value of the dollar from being linked to the value of gold held. And essentially, there started being now a movement in value between currency and what was actually then called the real economy as represented by gold at the time. And to track this movement in between, we introduced the term inflation. And that's why you can see in the definition, we say which can erode the value of your investment returns. We also say it reduces the purchasing power of money. But the way I also like to think of it is that what is the link between the piece of paper that you now hold in your hand and the gold that you are allowed to go and claim if you go back to 1970 into a vault? The reason that's important is because what that then has done over the years, and if those of you that are interested in Googling, you can go on Google, or you can even sit with your grandmother and you hear the stories about how in my day, 1 rand used to buy this, that. And you sit there wondering, is she lying, or what has changed? Why are things so bad or things so expensive? And that percentage, that is the accumulated amount that this $1 used to be able to buy. Now it can't anymore. And that's because so many more dollars have been printed, and it is that much more removed from the actual economy that exists, the real products that we have on the ground. And we're going to use examples in the Q&A. We're going to use examples as we go later on. But in essence, inflation is an increase in the overall prices of goods and services in the economy. As most of you would know, it's a decrease in the purchasing power. It's a measure of what does 100 rand buy me today that it never used to buy me 2 years ago, 5 years ago, or what could I buy 5 years ago with 100 rand that today I'm not able to buy? That decrease or that change in value is what we call inflation. Now, before we go into how can you combat inflation, the thing that I want to discuss that we often mistaken is the concept of actual inflation and lifestyle creep. So for example, if you were buying a tin of beans last year for 10 rand, and this year you're buying a tin of beans for 11 rand, the inflation is 10% on that. The price of goods has gone up by 10%. And I think we're all comfortable with that. What we often miss, and this is now where it becomes important for personal finance, is this concept of lifestyle creep. Lifestyle creep is when you used to buy a tin of beans last year for 10 Rand. This year, you decide you don't want beans, you actually want steak or you want mushrooms. We can track the change in price between mushrooms last year and mushrooms this year. We can also track the change in price from beans last year and beans this year. What often doesn't go tracked is how much did you used to spend on food, for example, and based on the fact that you changed what you are buying. So because you now no longer buying beans, you're buying mushrooms, you're paying, let's say, 15 Rand for mushrooms. We now have what we call a 5 Rand lifestyle creep, of which that 5 Rand can be broken down into actual inflation and actual lifestyle creep. And why that's important for personal finance, again, you see it a lot of the times where I remember with my first salary, I could do so much. And now that I earn what I earn, it seems as if I can never get paid enough. And I wonder what used to happen to that, whatever, 5,000 Rand budget that I used to have, and I used to be able to save and go on holidays. A lot of it not only has been eaten by inflation, but a lot of it has been eaten by the fact that I've also changed the quality of the things I consume. You know, I've got pH 10 water in front of me. And the other day I was telling the lady that sells it, or I don't understand, the same amount of water I actually stock up when I refill my 10-liter bottles for the same amount that I buy this 500 mils for. And that's lifestyle creep. And often that's where a lot of money gets lost, right? So that covers inflation comfortably. In terms of how to combat it, we'll come back to those in the Q&A. So I'm comfortable, in Bali, that we can skip those and the personal inflation and then go straight to assets. There we go. So we had prepared quite a bit for you guys. And as I say, I want to make it more conversational. So I want to just give you enough that we can engage, and then we can always come back to the slides later, right? Now, when it comes to assets, an asset is something that has monetary value and can be owned by an individual or an entity. That's it, right? Your house, your car, you name it, assets. Stocks, bonds, real estate, vehicles, other properties, assets, as you see there with the examples of assets. The reason I put these two together, assets and liabilities, is that you often get this debate where people say your house is not an asset, and they will tell you what Robert Kiyosaki said, and then they get confused and what happened in the accounting class, and oh my God, what's happening now, right? And this is what I would comfortably want you to be able to understand with assets. Your house is still an asset. It's still an asset. Your house is still an asset. Your car is an asset. Don't let someone tell you GTI liability. No, GTI asset. You got it from me today, right? What's often missed, and that's because we study this in finance, is that often enough, those things are attached or financed using some other instrument. And that's the liability part of owning a GTI or owning a house or owning that particular thing. And that is why most of us would advise you, if you can, as far as possible, buy those things cash. The minute you buy them cash, you're now left with the asset, no liability component. And then next week when we cover expenses, what in DIY personal finance we have used as the disqualifier for making this thing an asset or not, it's actually an expense. So the fact that you have to maintain your GTI, that's the expense related to it. It's not necessarily a liability, it's just the fact that's the price of owning a GTI. That's the price of owning a house. You're gonna have to clean it. You're gonna have to change the geyser when it's burst. That doesn't make it a liability. It just means that there are costs associated with the ownership of that particular thing. So I'm comfortable with the fact that things that you own that have got monetary value are assets, right? And you'll see when we get to investments why I'm so particular to stress those, because even they've got costs associated with them. So to just take a blanket wide definition that says if it costs you money, it's a liability is a bit wrong. Liabilities are more, what do you call it, financing instruments. And a lot of the times it's what we use to buy assets. And that liability component is what I would fight you on and encourage you to decrease if you want to be financially wealthy. Now coming over to the liabilities themselves, right? I think in your slides, Bali, we had investments before we had liabilities. I think to not have you running around, let me talk to investments, then I'll come back to liabilities. Oh, there you go. Okay, I'm happy if you can click there. Yeah, now we know how the technology. I thought they have to go in the order of that picture that's there, right? A liability is a financial obligation that a company or individual owes to another party. If your car breaks, there's no financial obligation on your part. There's no one that can take you to court because your car broke. And you've seen it if you've driven around Kokasi. The cars didn't you know, you don't have to fix it. That's why it's not a financial obligation. The fact that you then go and fix it, that's why it's an expense. It's money that you decide, I've got, I'm not gonna buy food, I'm gonna buy a tie, I'm not gonna buy this, I'm gonna fix that. Other ways is you can actually fix it yourself. I don't advise it. This is not engineering advice. You can go and fix that compared to the financing that you took out to buy that asset. That if you skip once, twice, someone will knock on your door and say, Chief, please bring that car. So there is that financial obligation tied to the ownership of that particular asset. So a liability is a financial obligation that a company or individual owes to another party. It represents an amount of money that is owed and is expected to be paid in the future. Liabilities can be classified into two main categories, short-term liabilities and long-term liabilities. If we go to types of liabilities, you're looking more at things like your credit card, payments that need to be made. If you owe any debtors, your taxes, if you've got any short-term loans, those things have to be paid. There is an obligation. If you skip a month without paying them, you'll see who loves you on your phone book. Normally it's a 011 or 021 number that will very promptly remind you, hey, you owing us this amount of money. When it comes to long-term liabilities, again, that's where you're dealing with long-term loans, bonds, those sort of things. And I think what's interesting when it comes to why we encourage you to pay off your house much quicker, why we encourage you to actually buy it on cash if you can, is I looked up the definition of mortgage, and it's actually derived from Latin, mortis, which means dead. Then mort, it evolved to Old French over time, which means pledge. Mortgage was then to pledge. And then when they combined the Latin and the French, they then came up with a dead pledge. And that's actually one of the reasons why you'd find that when you take out a mortgage on a house, as I say, it's normally 20 to 30 years. Again, stemming back from that period, the 70s, the 70s, where you were expected that you'd be paying this off for the rest of your life. So it was essentially a dead pledge. And also what's interesting that has evolved from the concept of a mortgage bond that you take out on a property is that you're actually required to have life insurance or life assurance on that bond. Again, we've got bankers in the chat, in the audio, so it's going to be interesting to talk about that. And the bank knows why they've got your life insurance taken out on your mortgage. And that's because if they've got their calculations right, you should be paying this off until you're dead. When you're dead, the balance outstanding, an insurance company should pay them back for their money. So they're very comfortably covered in that sense. How I want to relate assets, liabilities to inflation, right? And it will come back next week as well when we discuss interest, income, dividends, those sort of things, right? When we move from the gold standard in terms of currencies, you would find that people that have got a lot of money now all of a sudden found that they've got a lot of pieces of paper and not necessarily pieces of paper that entitle them to gold anymore. And they then started rushing to put that large chunk of money somewhere where it can retain its value. Because now that it's no longer linked to the value of gold, it's linked to government's ability to print money. They very quickly understood that the longer I hold on to this piece of paper, the more value I'm going to be losing, because this year it's going to buy less than I'll be able to buy. I mean, next year it's going to buy less than what I would have been able to buy this year. And the immediate thing that made sense was either to buy the gold coins themselves, and that's why you would very commonly find a lot of people saying that gold is a good hedge against inflation, especially in stock market conversations, those sort of things. And that's also why you would find a lot of people then started saying a house is an investment. What they actually were trying to say is that a house is a good way to retain the value of your money, especially if you've got large sums of money, to convert it into a real thing that we can see and purchase later on. Because now you can sell the house to get the value of the money that now the house is worth at that point in time. And so that's where now inflation started being linked very closely to assets. And at the end of the series, we're going to have an even more complicated conversation about what happens when inflation goes up, what actually happens to the value of the house versus the price of the house, all of that fun stuff that accountants do on weekends. So the important thing I wanted to just point out here is that your house is an asset and not an investment, because it's intended to store your wealth, not necessarily to grow it. When you're buying a house, the idea is not so that one day you can be super rich. When you're buying a house, the idea was that actually you can be able to retain a lot of your wealth that you have worked hard for in this corporal thing that you're able to touch on a daily basis, which then takes me over to investments. But if we can go to investments. And now this thing is so fast actually that one of the things I wanted to touch was credit score under liabilities, but I think we'll touch on that as well. When we come to investments, the one thing I want you to pick up out of the slide is, I think on point 3, there at the bottom, it says, in other words, an asset is something that has value and can be owned, while an investment is a deliberate decision to allocate resources with the expectation of achieving a certain financial goal. The reason we want to now talk about the difference between an investment and an asset. Now you've got your 4, 5, 6, 7, 8, 9 Lamborghinis parked in the garage. You've got your 3 mansions, a holiday home, you name it. And some guy that just read Rich Dad Poor Dad comes to you and says, you know, you've got liabilities, and you go through the conversation with them about, no, these are not liabilities. These are stores of wealth. What you'll often find is that, okay, now that the expenses associated to the ownership of these particular things, right, you can see more or less down the line that you may not necessarily be able to keep up with those payments. That's number one. The second thing that you will also find is that your house may be a good store of value, so it may keep up with inflation quite well, but it still lags somewhere. So what tends to then happen is that you start realizing that, oh snap, the expenses associated with the ownership of this thing. So interest rates went up lately. Petrol prices have been sky high the last 3-4 years, if you can remember. And now again, this concept of inflation has become topical. And why is that the case? That the concept of inflation has become topical? It's because again, now we're realizing that the assets that we own are becoming difficult to keep or to maintain. And so then evolved this realization that actually, let's not just try keep the value of the assets, let's actually try and get more than the value of the assets. And as well, when you also read on wealth creation and how you can make more money and become financially free, we'll discuss that even at another point in time, because I'm not a fan of saying 9 to 5 is dead and everybody should be on an island somewhere avoiding traffic. There is a lot of fulfillment in 9 to 5s. Came the concept of investments. Investments, on the other hand, they've got a mandate to actually grow your net returns and to grow how much your wealth is worth. And that's where investments differ from assets. So that's where now you get people then saying that you should maybe look to rent out a room in your house. Or in my case, what we've then tried to do is use part of the house then as a business where we can generate income from that. And the idea was to take an idle asset, something that has value and can be owned, and turn it into something that can help us reach a particular financial goal. Investments are there for wealth building. Investments are there to not just match inflation, but then to beat inflation as well. And if we can go back, Mbali, to the definition of inflation. The idea with all of these assets, liabilities, investments, when we come back, circle back to the beginning, is to make sure that you don't end up in a situation where you are competing with inflation and it's you, as the meme says, Zining and Niwan, it's you versus inflation. Because the Reserve Bank can print money much quicker than you can get a salary increase, much quicker than you can get a new job. The idea was then to introduce assets, number one, to at least preserve the money that you've worked for. And then number two, to then add investments to be able to increase the value of the returns from what you've worked for, so that you can maintain your ability to afford goods and services in the economy, and so that the purchasing power of your money can take you that much further in the future. I think I'm gonna just go to liabilities. One important thing that always comes up when we talk about liabilities and debt, that sort of thing, because the standard advice in personal finance is avoid debt. And if you're sitting up thinking I'm gonna tell you not to avoid debt, then you're like, yo, this Saturday, because I'm not gonna tell you that. I still do maintain, please, by all means, avoid debt. The problem comes now, if you've read Rich Dad Poor Dad, they'll tell you that a guy in suits like me is dumb and is not educated, and he'll tell you that we don't understand the difference between good debt versus bad debt, right? And then there comes this concept of credit record or credit scores, and people then wanting to know, how do I build my credit record? Just to contextualize that conversation, right? Debt is bad, full stop. The reason I say debt is bad, full stop, is because we don't reason from exceptions, right? In order for you to use debt well, you need a certain level of financial education, which you will have by the end of the series, and then you'll start getting creative with debt. But as a bell curve rule, you're already now an outlier from what we deal with on the everyday. That's number one. Number two, debt introduces now the concept of risk, the concept of being able to track risk-adjusted returns versus the interest that you're paying on that debt. Again, a complicated enough topic for me to be able to say to you that if you can avoid debt, it's very unlikely that you'll end up poor. What will happen if you avoid debt is that it will be very easy to see that you don't have certain assets that some of your friends do have, and you're not able to participate in this game called keeping up with the Joneses, or the Jeffersons, as the Jeff there shows, right? And that's where now this whole notion of retire young, retire rich, this notion of is a 9 to 5 worth it or not, comes in. You start wanting to then live a certain type of lifestyle, and then it becomes very clear very quickly that your 9 to 5 is not necessarily going to afford you that type of lifestyle. And from a personal finance perspective, what I want you to note with that is that you've deviated from a particular framework of finance, or of personal finance. And that, again, if we go back to inflation, not on the slides, number, otherwise Shem, you'll get tired going back and forth, because I'm going to come back to liabilities. The idea was to be able to get a job that allows you to live off what you're getting. When inflation came in, what you were getting started competing with this concept that is running faster than your salary increase and that sort of a thing. But when lifestyle creep came in, you introduced a component that has got nothing to do with inflation. And then that's where liabilities came in. And they said, no, don't worry, you can still go after that lifestyle, just buy it on credit or just finance it this way. And then essentially, as long as you can pay us back, we then will be able to, I think, to stand between you and your dream goal. And you pay interest, which we'll cover next week, the time value of money. Why I wanted to give that bit of background is so that when we come to the question of then, what about building a credit score? I want you to very firmly understand why you're building a credit score. Most of the times, you're building a credit score so that you can be able to afford to buy, first of all, to get a credit card, and then to be able to buy these assets that we spoke about, right? Also, to understand with that is then that we are trying to put you on a journey where you can be able to afford them as far as possible without needing debt. So you're building a credit score to be able to buy these things that are gonna indebt you, and it's a vicious cycle, so to speak. So to then mystify the concept of a credit score, you can afford your assets cash. The concept of a credit score doesn't matter to you. But you also know very well that I think there are very few of us, if any of us on the call, that would be able to go now and buy a house or a car cash. So the concept of credit score then becomes very real. Now, understand it's a gateway drug. Most often you go, you take out a credit. I think the common example that they use is go buy a shirt on credit, clothing account, and then pay it off. And then that will start building your credit score. What are they tracking with that? First of all, the misnomer, or the thing that most people don't understand, is that it's not necessarily about the amount. The credit bureau or TransUnion, if you have, they're looking at what we call a fractional values or fractional inputs. They're trying to understand your character as a financial entity. So they're not necessarily looking to see, are you able to handle 2,000 Rand or 10,000 Rand or 100,000 Rand? They're looking to see, are you able to handle a debt? And the components of handling a debt is, do you pay it back? Do you pay it back on time? And then how much of it do you have? But the how much of it do you have is not 10,000 Rand versus 100,000 Rand. It's 10,000 Rand versus your earning ability, versus your pay slip or what have you. So you do get to a point where you overbuild your credit score, i.e. if you've got too much debt for the pay slip that you present, that starts to count negatively. And then you also do get situations where, for example, you buy your 200 rand, you get a 200 rand store account, and then you buy for more than 90%. So let's say 195 rands worth of that 200 rand that you got on the clothing account. That counts against you because you actually seem to be displaying behavior that says you are dependent on the credit. So you're using more than 90% of it. And that's where this concept here, building a credit score, can become often very misdiagnosed or miscommunicated. And you end up in a situation where all you wanted to buy was a car or a house. You went to buy a t-shirt and never came back. Yeah, and so that's that. Last thing before we go into the Q&A is just to tell you that a lot of these types of conversations you can get on what we call the Fat Wallet Show. I think we'll type it in the chat box, the Fat Wallet Show. The one on the 5 concepts to make you rich or to financial independence is episode 46. And then the one on building your credit score is episode 42. And I think for today, as far as the presentation or the conversation is concerned, I'm gonna leave it there. I think what you can just do, Nembali, let's just go to the big circles just so that I can show you what you're gonna be able to see in the slides. So if we go on the 1-year inflation, under inflation, we've covered how can you combat inflation in the slides. Just come back. We've also discussed it as actually. And then there's the concept of personal inflation. Under personal inflation, it's these 3 circles. What are the influences? So what are the items that affect your personal inflation? It's your the area that you stay, your individual household, your behavior. I included a term they called lifestyle creep. We often count that as part of personal inflation, where it's actually a change in lifestyle. Then from influences, I've also covered hedging. So what I want you to see in hedging is what's happening, or sorry, not what's happening, how are you able to keep fighting inflation? And you'll see one of the things, the first recommendation is investing in assets that increase in value with inflation. That was the exact first thing that I mentioned, that the minute the currency stopped tracking the price of gold and started tracking the character of politicians, that's when you saw that people started putting their money into hard-earned or real type of assets instead of keeping it in paper format. And then we give you a list of other things there. Then after hedging, we went to assets versus inflation. So there, what I did was I just asked ChatGPT to quickly do an analysis for you guys on which assets are the best or better at keeping up with inflation, and then slightly beating it. As I said, because we're under the assets category, most of them will keep up with inflation or just do a percentage of inflation. I don't think I did investments that beat inflation. And that's because you start to go into a much more nuanced type of a vehicle for personal finance reasons and what we engage with on a daily basis. The average person, myself included as the average person, we normally use our day-to-day lifestyle expenses and assets to keep up with inflation, whether we know it or not. And then investments, normally we reserve that for surplus funds, not necessarily on daily consumption. I think that covers inflation. If we go to assets, just one back to the blue circle. So assets, you'll see what we engaged with under assets, or at least the mind map that I had for assets was what are the different asset classes. and then just the risks of each of the asset classes, just so that you can also look for yourself, okay, why would I not want to keep cash, for example, as an asset? Okay, what about bonds? What about real estate? What about stocks? And then commodities like gold, oil, all of those sort of things. Why would they be risky to hold as an asset? And look what it says there for gold. Commodities such as gold or oil can be used as a hedge against inflation. And I think it's a definition that comes back on itself. That's because inflation became a thing when we moved from the value of gold. So it makes sense that gold would help you hedge against inflation. That's just a little finance joke on that. Then I think let's go to investments, Bali. Under investments, the main thing there that I just wanted was to capture what's the difference between investments and assets. Most personal finance conversations just touch on the assets part of it, and they don't necessarily go into the difference between an investment and an asset. And that lands a lot of people in trouble because now they start seeing their house as a liability and not necessarily as an asset, a thing that you can own that has got value. I myself, I think if you follow my statuses or a lot of my conversations, I'm very guilty of that, by the way, where I will refer to property, for example, as a horrible investment and also feed into the stereotype that property is a liability. I'm an industry player and I just use the language of the industry. But what you wouldn't know is that it's very clear in my head, actually, why I fight property when we're talking investments, whereas why I wouldn't fight property when we're talking assets versus inflation and assets even versus liabilities. And then I think we can go to liabilities, Bali. Under liabilities, I just covered the different types of liabilities. And it will list the different types of liabilities. The other thing that I thought was just interesting that comes up a lot was to put real estate. And then the question I asked there, if you can zoom into real estate, Bali, the important thing that I covered there was how can a house be a liability? And that was just so that, you know, we close that ongoing conversation or ongoing debate about why a house can be a liability. Just so that at least we can put those things to bed. And then going forward, you can buy your houses in peace if that's what you choose to do. Or if you choose not to buy your house, you can then again choose not to buy it in peace. And then that will have covered today's topic, inflation, assets and liabilities, and as well as investments. And I think we can go into my part, my favorite part, the Q&A or any conversations or discussions that you'd like to have. As I said, the slides, I think they have been posted, or I hope they have been posted. And yeah, they're there for your reading pleasure, and they will educate you a lot more technically on these concepts. I just wanted us to have it in conversation format because it's not every day that you'll be able to take me home with you and say, but the definition says this, but when I experience it. And I think that's the biggest thing about finance, is that you start with very good intentions, you do all these good things, and before you know it, you experience it. So I wanted to at least give that experience a voice. And I think we can go into the question Q&A.
Thank you so much, Lesegisha. That was quite informative. It's a lot to take in for a Saturday morning, but it's all good information. There were a few questions that did come in while you were speaking. The first one was, can a house become an investment in the future? So I hear you saying that, and this came directly from me, that it's not an investment, it's an asset, right? But later, when you've paid it off, does it then can we then classify it as an investment rather than an asset, or both?
Yeah. So I'm going to take, but I think please don't click into the slides anymore. Nah. My attention, I zoom in and then I start reading. Nah. What I wanted to clarify when I touched on assets in my prepared presentation, right, was let's start seeing it the way I see it as a finance professional, right? Your house is an asset today, tomorrow, in the future, forever. Then there is a contract that you sign called a mortgage agreement. So you've actually entered into two transactions when buying a house, right? The second transaction is the liability. So whether you pay off the house or not, it remains an asset. The mortgage is actually what you're paying off, and that's the liability. Now, I put the liability down and I put it away. You don't have to wait for the future for your house to then be wealth generating, for it to be an investment. Your house can be an investment today. It doesn't have to be after you've paid off your mortgage. If you pay off your mortgage and do nothing more, your house is still just an asset. It doesn't become an investment through the passage of time. For it to become an investment, you then have to actively make it generate more income than inflation. Does that answer the question?
Yeah. Yeah. The other question that was posted, I'll just read some of them.
Okay.
So, okay, this is actually a comment. Someone was asking for you to please go into more detail regarding personal inflation and hedging, going through each asset class.
Okay.
Each asset class, yeah.
Oh, that's a loaded question. So go through hedging against personal inflation.
Personal
Okay.
Personal inflation and hedging,
Okay.
going through each asset classes.
Okay. I'll just clarify the word hedging, because I know it's a financial term as well. And you then get hedge funds and whatever, and then before you know it, there's an English word that has now got a life of its own, and now people think you are doing forex. Meanwhile, when I just speak good English, right? Hedging, we just mean, okay, inflation is happening. How can I protect myself against this inflation? Or how can I, the same way with your house, the bank gave you a contract for you to be able to pay off the value of the house. Similarly with inflation, we're now saying, what can you do? What instruments can you bring in to help you fight against inflation, or at least to pay off inflation? And that thing that we are doing is we're saying we are hedging, right? We are protecting, we are combating inflation. If we can go into the hedging slide, Mbalia, inflation. I think because it was specifically requested that we go through it, different asset classes, right? So hedging, an individual can protect against personal inflation by taking steps to protect their purchasing power and financial well-being over time. Some strategies that can be used to protect against personal inflation include, let me scenario. By the way, I do see cartoons in my head when I receive confusing finance information. So you've gone to work for 30 days and you've got your pay slip at the end of the month. And you sit down, your mom, your dad, they say, you need to start buying assets. Utenga nini moto, utenga nini indlu, all of those things. So depending on whether it's your first paycheck or your 10th paycheck, but you've reached a certain point where you're starting to feel uneasy that after you've gone through the month, you've paid your rent, you've bought your groceries, whatever, you have some money left over and you know that that money is losing value, right? What then can you do when it comes to the hedging? The most common one that I've seen is that actually turn your hard-earned money into real assets immediately. So some of us will then start buying shares, investments, that sort of thing, because it hits two birds with one stone. On the one hand, it is assets, but on the other hand, it's also investments that are fighting inflation. But the more common one would be to buy an asset that just stands still and then just at least preserves the value of your money. So that's number one, investing in assets that increase in value with inflation. Someone would say, but a GTI doesn't increase in value with time over inflation. I don't think I want to go into the mechanics of that. What I think we can, at the bare minimum, agree is that a GTI, you can own it, it has value. The likelihood is that after 5 years, somebody will buy it for more than what you would have gotten if you had just kept the money in cash or something similar. It wouldn't have eroded as equally. Obviously, I don't know your driving patterns, that sort of thing, right? An individual can invest in assets such as stocks, real estate, or precious metals, art, you name it, that tend to increase in value with inflation. This can help to preserve the purchasing power of an individual's savings in time. Do you get a personal financial advisor? Okay, I'll not read the questions. That's Dumelo's
Yeah, you can
job.
leave that to me.
Yeah.
You can leave that to me.
So that's number one with that. Number two, building an emergency fund, right? Building an emergency fund, I left it under hedging against inflation because it's still good advice. When we get to emergency fund, we can then go into the nitty-gritties of it even more. The reason it's good advice is because at least if you've got an emergency fund, and for those that don't know, an emergency fund is where you actually build up savings, and those savings are targeted at offsetting your expenses when you no longer have an income. What inflation does is that instead of you no longer having an income, it says the income that you were earning last year that you drew this budget on is no longer enough to buy the same things you were buying last year. So building an emergency fund is a good hedge because it allows you, when you arrive at the till and they say it's now 1,000, I bought toiletries yesterday, get 1.8, instead of the 1.2 that you had in mind, you now have got a reserve fund where you can just take the extra 600 Rand and top it up. So that's what then makes building an emergency fund or that save for a rainy day. As I said, we're going to break it down when we cover emergency fund, but this is part of the rainy days. It's the drizzling. It's the drizzling when you get to the front of the till and you realize that I had budgeted 2,000 and it's 2,233. That 233 comes from your rainy day fund. Then managing debt is my favorite one. Managing debt, essentially try and pay off as much of your debt as possible. The reason is debt generally has got higher interest than what inflation is at. So over and above inflation, you actually even are paying more for that particular thing than you would have if that thing was now fully owned by yourself. So for example, when people complain that I bought a 1.5 million Rand house a year ago, we've now had 4 or 5 rate increases. I used to pay 9,800 Rand and now I'm paying 12,400 Rand. The inflation has crept into your interest rate and made the mortgage that you have to pay on that same house that much more expensive. And as a result, paying off your debt much quicker, here we say managing it, but actually paying it off much quicker allows you to preserve that 9.8 installment. And I'll give you an example. One of the things that we advise is that pay an extra 100 Rand or 200 Rand if you can into your car or your house. Why that would have helped is that, number one, you anyway with the 5 increases now have had to pay in that extra. But now the difference is that now that you're paying it when it's mandatory, it's going towards paying off interest. If you had paid what you are paying now, so that person that bought a house here, 1.5 million for 9.8, and now they're paying 12.4 for it. If you had paid 12.4 from the get-go, that extra 3,000 Rand would have reduced the amount that you owe on this financing contract. And by the time interest rates go up, your interest is on a lower debt. And as a result, you most likely would have stayed close to that 9.8 amount, because now the higher interest rate on the same debt is now on a smaller debt. And that's why managing debt works. Then building a diverse income stream. This is now really where you feel that you are competing for purchasing power. You now realize the job I got was for this budget and for this plan. Everything has now gone up in price. The job has said, now we are only increasing by COLA 2% or 3% or 4%. And you realize that, hey, the extra 3 to 5, 6% is not going to be covered by my job. You then decide that let me actually create other income streams. And that's actually where you start going into investments. So you now start saying that, okay, let me start having something that brings in money. And as some people have complained, hey, dividends come once a year and gets in that sort of thing. You then decide, let me also start fixing people's whatever broken assets. Or I work for a bank, people can actually consult me on weekends about how to manage their bond, and I make an extra income for that. All you've done is you've now created a second line of income, or third or fourth, so that we can continue to combat or protect the purchasing power and your lifestyle. And I'll repeat, the golden rule, if you can, there are many golden rules. The golden rule, if you can, try as hard as you can to fight lifestyle creep. Don't let a salary increase equal increasing where you stay, increasing the car that you buy, whatever. At a bare minimum, especially, for example, with a car that you can pay off, rather push to pay that off and then start living with the lack of a car debt for 3 months, 6 months, see how it feels, and then ask yourself, should I take the next conscious step of upgrading a car? Salary increase doesn't mean increase your car. Salary increase just means salary increase. But in the event that you're not getting that, then you then create a salary increase on the side and start adding income streams. Then reviewing your insurance coverage. This comes in where you accept, I can't do the former. I'm going to lose my assets. Let me actually just make sure that I'm covered for the full value of this car if I get in an accident. The last thing I would want is I get into a car accident or the house burns down, and then when it's time for the insurance to cover, restore my assets to its original value, they tell me that I was insured for the value of the asset and not the value of the contract. And then Bona, they're only covering the price or the value of the asset instead of the value of the contract. So this is where reviewing your insurance coverage becomes very important, just to make sure that you're still covered for the value that you actually owe, so that it can be able to cover the asset that you are protecting against. Increasing your income, I think it falls in the same category as diverse income stream, except here maybe they're looking more towards, ask your boss, chief, the increase I got is very disappointing. For the next year, can you and I come up with a performance plan that either means I'm going to earn a bonus, or it means that I'm going to be able to get a promotion in the coming year or so? What can I do to increase my income here? And then I think it's the last one or second last one is budgeting and tracking expenses. This again is just to make sure again that that lifestyle creep hasn't happened. You used to eat no-name beans, now you eat cool beans. And actually the price of beans hasn't gone up. It's just the price of the beans you eat have gone up. And that's where budgeting and tracking expenses comes in. The other one maybe you used to go out for 500 rands and then you decide that, you know what, I'm happy to go out for 400 rands instead of 500 rands. Inflation must also hit my fun time, and I'm good with that. Then if we can go to the, I think there should be one more, or was that it? Okay, that was it.
Now I understand why you're saying it was a loaded question.
It was a very loaded question. Yeah.
Yeah.
Okay. And I think now I can be appreciated for having kept my presentation under an hour. I think that's where the
Yeah.
questions start to really have value. Okay, let's have another question.
Okay, no problem. This is a different comment. It says, I hear the chat, but then how long are you going to wait to be able to afford things like houses? We don't have 700K to 2 million lying around. So yes, avoid debt, but if you have enough to buy cash, isn't it still strategic to pay off that house or car within 3 months? Avoid interest that builds up because life is just unpredictable. It's just a comment. So I think
Yeah. I have a lot to say, but
what's your take?
yeah, it's look, and that's why I wanted it in conversation format and not lecture format, right? Personal finance is like that. I don't think it's the first time today you're earning a salary and I'm telling you, don't do this, do that. The fact that you've lived this far and gotten this far pays testament to the fact that you are living and surviving, and some of you might even be thriving inside of the decisions that you've been making. This is just a touch base to let us know, a very important and a very deep touch base, I must say, to say that for someone that is lost, is drowning, this is where you are. What I'd want to appreciate about your comment is that once you have cash, you just have a lot of options that you can play with. And that's what you want to give yourself. You want to give yourself optionality. If you've got 1 million or 700,000 to buy a house, and I say go and buy it cash, you have the option to put 350,000 down, take out a mortgage on the balance, and then spend your 350,000 on something else, you know. But what's important is that you've got options. On the how long are you going to wait? It will make more sense when we cover the emergency fund conversation. What was important for me in this conversation, right? Inflation, assets, liabilities, investments, was for you to get a thorough understanding. Where do liabilities come from? Where do assets come from? Where do investments come from? Why did it all of a sudden become so fashionable that you own a house, despite the fact that some people may realize that, hey, renting actually is working out better or works out better, that sort of a thing. So I just wanted to have a common touch base to answer. Okay, Tumelo, you must tell me, you now answer the comment. I got
But I
carried
think
away.
you're going about it the right way because you're answering it, step by step, which is
Yeah. And this
yeah.
actually is supposed to give you that step by step. You see how I instinctively went through the mechanics of how long am I going to wait. And the idea is, let me not deviate from the original intention of this particular thing. So the how long are you going to wait? As I say, if you're comfortable that you're buying a house because you can afford it and it makes financial sense in terms of protecting your purchasing value, it's not lifestyle creep, that sort of thing, then how long you're going to wait is up to you. There's no rule book in life that says you have to own a house. And if you're 30 and you don't own a house, then you should feel, whoa, So the how long you're going to wait is honestly very subjective. just don't find yourself jumping into it because of how long are you going to wait.
Thank you so much. The next question is, please discuss the benefits of stocks as assets. It is as easy, or is it rather, sorry, as easy as setting up an easy equity account, I guess. What are the top 5 tips when deciding which stocks to buy, and how much and how often? I think also people, please feel free to join in the conversation. You know, if you
Yeah.
would like to comment,
Raise your
it's
hand.
not
Yeah.
just, yeah, raise your hand, speak, unmute yourself, because this is not just for Lesegisha and I, it's literally for everyone.
Yeah. Yeah. The me part has happened. Envelope I fihlile. Now we're just taking questions and engaging on it. We're gonna cover stocks. We're going to cover how to invest in stocks, that sort of thing. We're going to cover index trackers, that sort of thing. Stemming from the conversation of where did we start having this desire to own assets and investments, right? Or let me say assets. When inflation stopped being linked to real things, real reality, gold, right? And started now currency, not inflation, and started being linked to the whims or the morals of politicians. That's where inflation started. When that happened, the desire to own assets or the necessity to own assets came in just so that you can keep what you've worked for. Wabo? Investments came in when you wanted to have more than you've worked for. Coming to stocks, now how easy is it to buy stocks? Is it as easy as opening an easy equities account, select one and buy it? 100% it is. That's why it's easy equities, right? The question that I often actually use as well is how easy is it to buy a house? And Tumelo, you work for a bank, you probably can tell us better, Hore. How easy is it to buy a house? Can I today, Saturday, 10, 11, walking in my neighborhood, house for sale, call the agent, I want this house. Get it 11, I'm getting paid on the 15th. On the 15th, I would like my first installment to not go towards rent, to go towards this house that I am going to own, because someone said to me, I must stop paying my landlord's bond. How easy is it to buy a house? And yeah, I think it answers that it's a lot easier to buy stocks than it is to buy a house, because it is as easy as you open an easy equities account and then you buy the thing. What's not nice is the scary thought around it, the emotions around it. What does the red lines mean? What does the green lines mean? I heard of Steinhoff, I heard of Enron. That side is not nice. So it's definitely easy to buy it. It's not easy to go through the motions and the feelings of buying it. Top tips to look out for when buying stocks, what have you. The first one is to realize that you are trying to buy a share of a company. You are trying to buy a piece of an existing company. And we're going to cover a lot of these when we do the presentation on stocks. You're trying to buy a piece of an existing company. You are not trying to speculate on red and green arrows somewhere in Johannesburg or on the news. I know not the first time I saw stocks and whatever was on the news after the weather or just before the weather. They would do that part where they show you an arrow and a thing, and then we don't know whether it's good or bad. But green sometimes means, at some point I learned green means good, red means bad. You're not buying that. You are buying an actual company that exists in real life. For example, how easy is it to decide which medical aid to use? Some people just say, no, just go with Discovery. Well, there you go. It's easy then to just go and buy a Discovery share because you've already shown that you put your life when it comes to health in Discovery's hands. As a result, you put your life, again, when it comes to returns in Discovery's hands. I'm not saying that's how you choose to buy Discovery, but I'm saying at least from knowing nothing, that's a better way to buy shares in Discovery than to think that you're just going to buy one and then tomorrow you're going to become a millionaire. And then there are other factors that you look. You read the financial statements. I'm going to teach you guys how to do that later on. The things to look out for on the financial statements, which are going to be very similar to what we covered today. Assets, liabilities. You're going to look, does this company have more assets than liabilities? If yes, I think it's a good company. If no, I think it's a bad company. Don't buy it. Inflation, are they making more than inflation? Those sort of things. But in terms of the mechanical ease of buying shares, it is that easy. I actually even would encourage you, buy 50 Rand or 100 Rands worth of shares, just so that you can actually have the experience of the emotions, but on a small amount, so that when it's time to learn the mechanics of share ownership and valuing companies, the emotion part of it is out of the way. Yeah, well, most people have this relationship with shares that I'm afraid of losing money. And then they don't even start to begin with. And then as a result, yeah, it seems as if it's near impossible to buy shares. Meanwhile, it's near impossible to get over the fear of losing money. So I think do that. Yeah. Tumelo?
The next question is, for credit score, do we need a credit card or is a car sufficient?
I'll leave that to bankers. Yeah, I think I'll leave that to bankers. Where a car is sufficient is because, number one, if you have a car, you have a certain credit score already. And so if you pay off your car as you should, then you are complying with one of the components that feed into the calculation of a credit score.
Okay. I think this was from Amina. It says, do you get a financial advisor to assist you in making or with investing in things like stocks or real estate, or can you do that by yourself? If you do it by yourself? How do you know that you're doing the right thing?
Yeah. I saw as well, I think she commented that she thinks she's been answered. I'll answer it anyway. You don't get a financial advisor. If you want one, you go look for it. You can do it by yourself. There's no requirement that you have to have a finance. So it's not like buying a house. A house, I can see the house I wanted. And then jiggy, there are agents involved. But I'm like, I've got my 4 million in my briefcase. We're not batlang. I know they either agents or is it the notaries or you people, Bali? Is it conveyances? The lawyers studying
It's conveyances.
Conveyances, ne? Yes,
Yeah.
they get involved somewhere, and I don't understand why. With shares, you can do it by yourself. So in easy equities, you 100% are on your own. The one that the conveyancer equal to that is a stockbroker. So you do need a stockbroker, and Easy Equities, for example, has got a stockbroking license that allows you then to just use their license to access the shares. So yeah, you can buy it by yourself if you want. In terms of how to get help on it or how do you go about it, as I said, we're going to cover that in the conversation on stocks. And I think what's important that I always have when it comes to that one, getting help buying stocks, nah, what I always try to use as a benchmark where I want to get you to when I teach you how to invest in stocks is, if you sit Limajita and they're talking about cars, and I used to have that a lot. I think I still do have it. And they talk about horsepower and RPM. And And you're just sitting there like, oh. But how many of us have got cars? We all know that when I get to this point, I'm gonna buy a car. When I get to this point, I'm gonna buy a better car, a bigger car, whatnot. And we all sort of have a agreement. I don't know when we met and decided as adults, adulting, we are going to agree that this is a good house, this is a good car, this is a good whatever. Despite the fact that if you sit down with an engineer, they actually would be able to break down a house and say, oh yeah, this lovely looking house, go midstream, it's got foundational problems. The walls are not built well. The roof leaks, this, that. There's actually technical specifications that you can use to look at any asset. And some assets just happen to enjoy the benefit of not being appealing or being more readily available to your eyes than you having to engage an expert. And I actually want to help us get through that so that you have a situation where even for stocks, you don't have engineers selling stocks, because we don't have engineers selling houses. We don't have engineers selling cars. So we want to get to a position where we've got a common understanding of what a good company versus a bad company is, irrespective of whether you have a financial advisor or not. And then when I say the financial industry has made it a point that you feel like that, that's what I'm talking about. The millions and billions that companies go into advertising why investing is risky and whatnot is so that we can say, come and give me your money, let me do it for you because you're incapable of doing it yourself. You don't see engineers doing that with houses and cars. And then we have cars that break down and houses that leak. And we don't even blame engineers still. We just blame the previous owner. Or, hey, he didn't look after the ceiling, but someone signed off on that house. Yeah, yeah. You can hear my preferences, but as I say, it's the words coming out of my mouth. I am educated in these things. In my personal life, I do live in a house. I will buy a house. I will love my house. I won't look at it as a burden that an engineer put on me. It just so happens that the platforms I get where I have to engage at a technical level on assets, one of the best ways I've found to do that is to contrast them to one another and maybe create some uncertainty about the things you're comfortable with, so that we can take that common uncertainty and then build confidence for all your assets, instead of having some assets that enjoy confidence and some that don't, and then you can't make financial decisions because of the disconnect in emotions between assets. So yeah, Amina, there's your answer.
Thanks, Mina, for that question. Guys, please feel free to ask your questions. I'll read them out, but I mean, because it's your question, I think you should be the one to interact with Lesegisha, because he'll give you more information, and maybe if you have like a follow-up question, you can go ahead and ask those questions.
And nobody will know what's in your bank account. Sorry, yeah,
it's okay.
I get that a lot when I'm supposed to, especially in the early days when I would meet with Simon Brown and I wanted to ask a question. And that's what I keep saying that I want to do. I want to take away that thing of the feelings or the emotions around it. Finance has made us feel as if when we're discussing finance, if I ask a question, people will know I'm poor or I have money. No, you just ask the question.
Yeah. It's as if it just has more information than what you're actually saying.
Yeah.
So the next question is, how do you make your house generate more than inflation if rent can also be kept, assuming that you were talking about rental income?
Yeah, the first one is find out what the inflation is that you're trying to, and I think it's important, maybe because of the way I'm going to answer it. So it's a good question, right? That's why we broke down inflation into the factors that go into inflation, or the things that affect your inflation. So, for example, if you're using your house to combat against the inflation, it's going to be, because I see it in my head, I'm going to use water, Apple, and a car. I buy an ETF to combat against the inflation that I will experience from my expenses for water. So as a result, as long as the ETF can do whatever, 3-4% exchange traded fund, unit trust, as long as the unit trust can give me a higher return than the increase in the price of water, I've hedged against it. Coming to the question, rent can be capped. How then can I increase the returns of a house, or the income of a house, to fight inflation? What inflation are you fighting? And the inflation that you're fighting, I'm assuming in this case, is the inflation on your interest rate, right? How can I increase the house as a hedge against inflation, against the interest rate increase? And that's where, as you say, so if I exhaust the rental, that's going to be done. And then I look how much is left. So I'm getting 10,000 Rand in rentals. My bond is 10,000 Rand. Interest rates go up by 0.25%. And now I'm paying 10,000, I think 250 or 25 Rand. What is rent capped at? Traditionally, I've seen rents increase around 8 to 10%. So I can increase my rent from 10,000 to 10,800, right? But inflation on interest rates only increased by 0.25%, meaning that actually I'm beating inflation with my house. So I think I would start there, looking at how much is the rent covering of the inflation on the interest rate. And if it happens, like in this case with the example I used, inflation went from, because of inflation, your repayments went from 9,800 to 12,000, whatever, 12,400, hypothetical example. And you are 100% saying my rent can only go up to 11,000 Rand. How do I cover the remaining 1,000 Rand? Maybe the house is not the thing that's supposed to hedge against that 1,000 Rand. Maybe paying off an even bigger amount of the house so that the outstanding debt on a mortgage is lower is what will bring the 1,000 Rand gap a bit down. Obviously, it won't bring it down by 1,000, because I don't think you've got 50,000 to reduce your house debt. But essentially, it's that, first of all, acknowledge and pat yourself on the back that you've done some hedging of the inflation increase, and then the remaining amount outsource to something else. See if you can engage with the client, or if I put in Wi-Fi, for example, would you be willing to pay an extra, whatever, 1,000 Rand, and then you save on data? And for you, the return on Wi-Fi is higher than the return on the rent as you keep on increasing. And you can hear that I'm going into financial strategies, but the principle is essentially that you then start looking at how to be more creative around your asset. If it's the asset you want to curb that, or you add other assets that can then offset the cost of your house ownership. There's no rules, it's a one-to-one parity. And I think as well, I recommended the book to the Stokvel, Manage Your Money Like a Fucking Grown Up. That's the book that I also would recommend you read for personal finance. And one of the principles that come out of that is that you also may need to, Sam did a lot of research and she will comment better on it. But the gist of that advice, or that chapter that she was on, and this is how we also see finance when we're using a calculator, right? We don't have money called rent. money called groceries, money called car, money called thing, whatever, bond. That's in your head. The reality of how finance happens is that a large lump of money comes in, large lump comes out, and if you have some left, you go do life. If you don't have some left, you make a plan to get the money back. So when hedging, yes, I've showed you how to match this to that, this to that, this to that, but there's nothing that says that stops you from saying, let me get a second job, and that second job is going to pay off my house much quicker, which is going to bring down my interest rate or my interest repayments to the bank. And as a result, I've hedged one lump against another lump.
Okay. I guess that makes a lot of sense. And I guess that's why it's also important to have that emergency fund.
Yeah.
And
Yeah.
also to just contribute, like you said earlier, 100 Rand or 200 Rand more, just to cover yourself when it comes to such instances. We've got two more questions. I think it's the last two. And the one reads as thus: you mentioned an emergency fund, but not a general savings account. Would you agree that it is not useful to save money in a savings account, but rather invest in funds, invest in those funds, or invest those funds, sorry, into investment options and get accelerated returns?
Depends what you want. If you want to create wealth with your emergency fund, I agree with you. For me, an emergency fund it must be there when I need it to cover the cost that I'm facing at that point in time. I'm happy to take the drag or the small loss on the interest. And that's because for me, the emergency fund is not there to generate interest for me. It's there to cover expenses that I sometimes face unexpectedly. So you're 100% spot on. It is better to put huge sums of money in better generating vehicles, but just don't then miss the cash flow aspect of it, where when you need the money, you have to put 30 days or 7 days notice, that sort of thing. Then you've just offset the cost of what it would have cost. I've seen people get credit cards for that. So they would put their money in a 30-day notice. An emergency happens, they pay it with their credit card, and then they make sure that they pay off the credit card before the payment is due. As I said, it's like the credit score building conversation. Some of these instruments become slippery slopes. You get a credit card to cover emergencies, and now emergencies start popping up everywhere like Beyonce tickets.
Yeah, I think Beyonce tickets are an emergency. Like, I think a few people here would agree with me. Okay, there's another question that's just come through, but the other one was, we have some students in the room who have never earned income before. What is your advice for their first paychecks? Seeing as most of it goes to immediate expenses like clothes and accommodation, how can they start being financially savvy from day one? I think that's a good question, actually, because I think we didn't have
so
this
too.
kind of.
Yeah. Look, again, it goes to different colors of answers, types of answers, right? And the way I'm going to answer it is to say, listen to how everybody else was asking questions, right? There's no, I'm a lawyer, therefore, how do I be financially savvy? I'm a this, how do I be financially savvy? In other words, it's difficult to tell by being a student what other mechanisms or supports or whatever you have around you. The easiest and first one that I give is sign up to the Fat Wallet Show. Well done for attending this, for example. This is a brilliant start.
I agree.
Yes. Learn the concepts around money. Learn what are the battles around money. Learn what are the stupid things that people you think are adults are doing. What's nice is that you also learn to see what are the good things that other adults that we don't see so often are doing. So education, first and foremost, is your biggest flex as a student. That eliminates whether you're poor, rich, whatever student, in terms of your bursary or pocket money or whatever. Then going into what do I do with my first paycheck? I normally say the best thing I did as well for my financial education, literacy journey, whatever, is actually to have conversations with my family and parents and find out where we stand on certain things and certain topics. So I understand, will they support me on my first rent or not? Will they support me on my first car or not? Will they support me on the uniform that I need? You know, I learned very quickly that you need a shirt, blazer, chinos, and shoes to go to work, which doesn't come with the congratulations, we've employed you later. You know, you get paid at the end of the 30 days. That's sort of a conversation. And I think it's a conversation I had with Tumelo once upon a time as well, that as much as we
Correct.
teach this like this, actually this is a team sport, you know. Have one or two friends, family that you engage on, and you let them know that, listen, you actually someone that I think is very responsible with money. I'm on this journey where I also want to be responsible with money. Can I use you as a crutch until I'm up? So in other words, I'm building up an emergency fund, for example. But if an emergency comes while I'm building up the emergency fund, can you cover me with no return, no expectation that I'll pay you back, for example? Obviously, it's a reasonable emergency, right? Or when you go out with friends, 100% let them know that, friends, I really would like to socialize with you. Friend one, can you cover my drinks? I'm trying to build up an emergency fund. Obviously, the immediate defensive response that one often gets would be, how, don't you think we also want to, whatever? Then that's the dynamics of your friendships. I don't know how you'd respond to that, but I comfortably would say, friend, you're not doing this. I am doing this. I'm asking you to cover me in this event. Yeah, well, if friend can't cover you, then you go and bite the bullet, but you still know better. You still know that this is the journey I'm on. So so it's financial literacy, number one. Number two, start actually building a circle of 2, 3, 4 people who are going to be your confidant or your engagement or your partners on this journey. And then by the time you get to that first paycheck, depending on what the state of that engagement has been, depending on the state of your financial education, the support that you have around you, you then can better navigate, how do I pay my rent? How do I pay this? How do I pay that? Other things would be being comfortable around certain lifestyle choices, you know. For example, I'm vegan, so I don't eat meat 90% of the time, right? Just being comfortable, it saved me more money to make sure my friends take away the stigma around me not eating meat than if I had continued to eat meat. And every time we go out, I know 350 out the pocket because I and you know, that sort of a thing. It's easy for food, for example. What about a car? You know, you drive a Polo, you drive this, and your friends are leveling up to Mercs. Did you deal with the stigma associated with Polo drivers or Kia Picanto drivers or this drivers or whatever? So that by the time you sit with your paycheck and you've made the decisions that this is going to be my lifestyle inside of this paycheck, you actually don't have external pressure to be for that lifestyle creep to come in. So that's where the education and the building the support system becomes very important for this, and then puts you in a position where you can comfortably then make the financial decisions that you would like to do. I mean, just as I let us go to the next question, when we're doing very good on time, I'm so anxious because I speak a lot, guys. The one thing that I did, for example, with my friends in varsity, we had this culture of on your birthday, we buy you a soccer shirt or we buy you your wish. And one of the things that I did for my birthday was I said I want shares. And that kickstarted as well my financial literacy journey, such that by the time my first job came, me buying shares was not even a thought anymore. It wasn't a financial literacy decision. It was just a norm that of the 900 rand that I was getting from the bursary varsity, 100 rand was always going towards shares. Now that I'm getting 10 times that just goes into shares, as I have been doing for the last 3 years in varsity. And so you start to see why those relationships become important. And you also start to see how the circle even becomes accommodating around that. Today, if I say to my friends for my birthday, I want shares, nobody's going to say, well, now you think you're better, whatever. Just ask for the account number, deposit it there, life goes on. So, yeah. Your student days are for you to get your set up. The same way you decide I'm going to be a lawyer, you do that in your student days. The same way you decide I'm going to be an artist, you deal with the stigma and everything during your student days. By the time your student days are over, you just live the framing that you've created around it. Yeah.
Thank you so much. So thank you so much to everyone that stayed on until now. We're actually doing quite well with time. Yeah. We have, Mbali has attached rather, a link to a form, and this is like a feedback form. This will help us with our sessions in the future, just to make them more informative, and just make them better. If you have not placed your email address on the link on that chat, please do so now, or maybe just send it directly to myself or Mbali, and then we will just ensure that you receive the presentation, as well as the recording, because we did record the session today. So I think that's going to help other people to sit and rewatch the recording. Thank you so much, Lesegisha, from us at Sinothile Stokvel, and on behalf of everyone else, I think this was really informative. I'm really looking forward to the next session. I don't know about you guys, but yeah, thank you so much. Thank you so much, everyone, for joining.
If I can, just to wrap up.
Sure. Yeah, you can.
Because I think you made an interesting comment, and I see Calvin says his question was, or he or she, his question wasn't answered. Just to touch on, I think after I presented, you said, that's a lot of information to take in. And I know I felt like that for some of my finance lectures. So I just want to put it in a nice package for you so that when you walk away, you don't walk away with, there was such a lot of information to take in. You walk away with, okay, that's what I was supposed to get out of this. And that's because that's what happens. At the beginning of a football game, you say my team is going to win or lose. And then a lot of things happen. And then at the end of the game, your team won or lost. But you walk away feeling like, there was a lot or whatever. So I just want to give that final score, right? Inflation is the difference between what's real and paper money, right? That's inflation. Assets try and close that gap or try and limit that difference in the gap. Investments try and grow and accelerate that difference, right? Investment returns are actually the opposite of inflation. They're the gap between your investments and inflation. That gap there is your investment returns, right? And then liabilities, where they come into this whole conversation, is that, as someone said, about Bill Gates, we don't have the 700,000 or a million just sitting around waiting to buy a house. So where liabilities come in is that often liabilities are what allow us to buy investments or assets. The cost of liabilities, however, just be aware, it adds to the inflation side of the argument because it also increases the gap between the money that you have and that real assets or the real value items like gold, like a house, like art, watches, the GTI, that sort of a thing. So inflation, assets, investments, liabilities, that's how they interact with one another. You're just trying to protect your lifestyle and the purchasing value of your money.
All right. Thank you so much, Lesegisha.
All right.
Okay. So I guess we'll see everyone in the next session. We will communicate when that will be. For now, have a great weekend, everyone. Thank you so much.
Calvin's question.
Sorry?
Calvin's question.
Oh, is there another question in the session, in the chat?
I think he had posted a question. I think something to do with, okay, I'm not looking at the chat.
Easy equities.
Okay. What's the question?
Yeah,
If I'm
as a foreigner living in another African country, how can I sign up for an investment financial stock account like Easy Equities?
Yeah. Traditionally, it's through a stockbroker. So if I want to invest in the US, Nigeria, Ghana, you name it, my first step will be to contact a reputable stockbroker there. And then they normally would be able to tell you that, okay, we need your passport number, your proof of residence, whatever. I know some investments have got actual, because there's tax implications. That's the big thing about whether you're a foreigner or not. So whenever in finance you see foreign being introduced, we're actually talking about tax. The big thing is to manage how will the South African government make sure that you pay taxes on income generated in South Africa. And then also your government is interested in how will we be able to get tax based on the income of our citizen. And the best people to know how to handle that relationship is stockbrokers or brokers, really. With Easy Equities itself, I think just go on the website and probably go to the FAQs. I know the two similar ones that I link it to, or the one other similar one I link it to, is if you're a miner and you'd like to invest on Easy Equities. I've done that for a couple of clients. And essentially the process is you fill in a manual form that declares that I am a miner, this is my guardian, this is my ID number, this is the power of attorney that that exists between myself and my guardian to be able to transact on my behalf. So I'm assuming even for a foreigner, there should be a similar process that declares to the authorities or to Easy Equities that says that I'm a foreigner, this is my details, and this is the power of attorney that I'm giving to this institution to transact on my behalf. Or as it will be on Easy Equities, you're saying that as I will be transacting, this is how I'll be transacting. The reason I'm not as clued up on the Easy Equities one is because when I joined Easy Equities, there were less than 1,000 people. Easy Equities now has 1 million users. So you can imagine I've been in it a very, very long time. And as far as I could remember, for a very long time, you had to be a South African resident. And then I haven't particularly kept up what have they done to to change that or to adapt to that situation. But if you were buying any other financial instruments, I know a stockbroker would be your go-to or your get-to that particular asset. So I think just check on the FAQs on Easy Equities itself. Luckily with Tumelo and these guys are lawyers. So I think they probably already are itching to go through their website so that they can answer you.
Yeah, we'll definitely go through it and we'll provide you with an answer, Calvin. If you don't find the answer, yeah,
Yeah.
we're happy to help you. All right. Thank you so much, everyone. Enjoy your weekend.
Thank you.
Thank you, Lesegisha. Thank you, thank you, thank you.
Welcome.
All right.